Short selling, often simply called shorting, is a trading strategy used in the stock market. This guide will explain how short selling works, what indicators can help assess how short a stock is, the concept of a short squeeze, and more. How short selling works. Short selling involves borrowing shares of a stock you believe will decrease in value, selling them at the current market price, and then buying them back later at a lower price. The trader's profit is the difference between the selling price and the buying price minus any fees or interest charged for borrowing the shares. The process: borrow shares. You borrow shares from a broker, which are usually sourced from the broker's inventory or another client's portfolio. Sell borrowed shares. Sell the borrowed shares at the current market price. Buy back shares. Later, you buy back the same number of shares, hopefully at a lower price, to return to the lender. Return shares and profit. After buying back the shares, you return them to the lender. Your profit is the difference between the sell and buy prices, minus any fees. Indicators of short interest. Short shares available. This indicates the number of shares that are currently available to short. A low number suggests high short interest, indicating that many traders are betting against the stock. Short borrow fee or interest. This is the fee charged by the brokerage for borrowing shares to short. A higher fee can indicate higher demand for shorting the stock, suggesting that it is heavily shorted. Short interest ratio, or days to cover. This ratio measures the number of days it would take short sellers to cover their positions, based on the stock's average daily trading volume. A higher ratio indicates higher short interest. A short squeeze occurs when a heavily shorted stock unexpectedly rises in price, causing short sellers to buy back shares to cover their positions and avoid further losses. This buying pressure can drive the price up even more, causing losses for short sellers and profits for those holding or buying the stock. Winners. Investors holding long positions in the stock benefit from the rising prices. Losers. Short sellers face potentially unlimited losses, as they must buy back shares at rising prices to cover their short positions. Risks. Short selling comes with significant risks, notably the potential for unlimited losses, since there's no cap on how high a stock's price can go. Margin account requirement. You must have a margin account to short sell, since it involves borrowing. Understanding these concepts and indicators can help traders and investors navigate the complexities of short selling and potentially capitalize on market movements. However, due to its risks, short selling is generally recommended for experienced investors.